This operating loss performance is 8.2% better than our initial expectations due to strong revenue performance, partially offset by higher one-time item expense. Our revenue outperformed across all of our service lines, with our national network and Northeast regional routes driving most of the change. Through April, we were able to deploy 1% more capacity than planned, primarily driven by completion factor, which drove 2.2% increase in ridership across the network. Additionally, revenue was favorably impacted by improved ticket yield of 1.9%, driven by both the Acela and Northeast regional lines of business. Overall expenses, while higher than planned, were impacted by one-time items, including higher than expected employee benefit health claim costs and a one-time impact of an unexpected lease settlement cost. We continue to manage our discretionary spend tightly across the board and adjust to the evolving environment to protect margins and cash flow. Our operational metrics are performing strongly compared to plan, with RASM, or revenue per available seat mile, better by 1.3%, and CASM, or cost per available seat mile, better by 0.4%. Turning to our year-to-date performance compared to prior year, April's adjusted operating loss is 25.5% better, bolstered by revenue growth and continued cost management. Revenue is strong across all service lines, and ticket revenue has grown 10.3% on increased capacity and a corresponding increase in ridership of 5.9%. Improvements in our ticket yield, specifically with Acela, is also driving additional improvement compared to last fiscal year. Shifting over to our expenses, we are continuing to manage our overall cost structure. We were able to outperform the labor and general inflation and keep expense growth to only 0.5%, despite an almost double-digit higher capacity deployment year over year. As a result of our cost controls, CASM, our unit cost, is 5.4% better than prior year, with lower spend in discretionary areas, including professional fees and employee-related expenses. On the capital front, our spend of $3 billion is higher than prior year by 52.7%, as we continue to advance our large-scale construction projects, including BMP Tunnel, and we continue to invest in our State of Good Repair program to ensure proper maintenance of our railroad infrastructure. Additionally, we continue our investment in refleeting efforts and ADA compliance across our stations and facilities. Now that we have discussed our consolidated business performance, I wanted to move to an overview of our two business segments, passenger operations and infrastructure. First, our passenger business, which includes our passenger train activities, remains strong and is performing 10.8% better than expected in the adjusted operating loss, driven by strong customer demand discussed previously. On the cost side, higher wages and benefits are offset by lower operations cost and other expenses. Operations cost improvement of $23.6 million is driven mostly by lower fuel rate and lower horse railroad cost. Compared to prior year, adjusted operating loss is 30.7% better. We are continuing to accelerate our financial results in this core segment and remain confident in our ability to deliver an adjusted operating profit for our passenger business by the end of fiscal year 2028. Now, over to our infrastructure business, which manages our rail network and real estate assets. This segment has seen tremendous amount of investment and growth over the last few years and has fluctuating operating results driven by cattle portfolio size and funding at any given time. The year-to-date adjusted operating loss of $118.4 million is mostly in line with plan. A slightly weaker revenue performance is offset by improved expenses, specifically in the salary and wages line. Compared to prior year, The infrastructure business has improved 9.9%. Moving over to our service line results, our profitable Northeast Corridor is performing strongly and delivered an adjusted operating income of $187.3 million with an operating margin of 21.2%. Compared to our plan, results are favorable by $23.6 million or 14.4%. Revenue is keeping pace in the NEC despite lower capacity driven by new Acela train set delays. Ridership and frequencies were above plan with our Northeast Regional service, which helped to offset the impact of those delays. Strong yield in both Acela and Northeast Regional helped to drive improved revenue performance. While we continue to advance our cost containment efforts, the NEC service line was negatively impacted by a one-time expense, which is driving unfavorable results in the CASM by 1.4 cents or 5.1%. Shifting now over to our national network and specifically our state-supported business. The adjusted operating loss for this service line is unfavorable to plan by 12.1% and is impacted by the timing of state contract executions as well as favorable ticket revenue, which results in lower subsidies from our state partners. These contracts are expected to close in the third quarter and the revenue to be recognized later this year. Overall costs are flat to plan, with savings in materials and train operations costs offsetting increased cost pressures in benefits. Finally, our long-distance service line has a favorable operating loss to plan of $10 million or 2.6%. Capacity increases are driving higher ridership across the network, though ticket yield is slightly down compared to plan. We are seeing strength in multiple routes, including the Empire Builder, Lakeshore Limited, and Crescent. Costs are performing better than planned by 0.3%, mostly due to lower labor costs, partially offset by higher benefit costs. Of note is that our long-distance network operation is mandated by Congress, and the operating loss is fully funded annually. Those funds are not recognized as revenue, but as owner's equity on the balance sheet under GAAP rules, thus driving a negative result on our profit and loss statement. Finally, looking at our capital compared to plan, spend of $3 billion is $617 million lower, largely due to delay in our refleeting efforts around Acela and Aero train sets. We do expect that the majority of this spend will still be completed within fiscal year 2025. Additional delays within bridges and tunnels, specifically the East River Tunnel, have pushed spend out of fiscal year 2025 and into 2026. Certain other projects have been impacted by funding timing. We continue to review and adjust our forecasted capital spend around our workforce and supplier base to maintain our cash balances while staying in alignment with our 5-year capital goal.
My name is Elliot Hamlish, Chief Commercial Officer at Amtrak, and we'll spend a few minutes discussing our ridership. April year-to-date ridership levels are favorable to same time last year by 5.9% and to plan by 2.2%. Northeast Regional quick turns and creative commercial tactics helped to offset Acela capacity constraints, which boosted ridership. Fiscal year-to-date April, Northeast Regional ridership rose 3.8% versus plan, while Acela ridership declined 5.4%. Year-over-year, NER ridership increased by roughly 11%, with Acela down roughly 2%. Turning to our state-supported service line, core demand has been strong, powered by the Empire service at 5.1% year-over-year, the Pacific Surfliner at 10.1% year-over-year, Cascades at 16.3% year-over-year, and Borealis at 27.7% versus plan. The delayed East River Tunnel outage supported ridership gains in New York, but the Horizon Fleet outage in late March interrupted growth. Cascades, which had grown 16.3% year over year, saw a 4.5% decline in April, mainly due to Horizon Fleet issues. Lastly, our long-distance service line. Deployment of additional coach and sleeper capacity across the long-distance network, Silver Meteor, 29% year over year, Cardinal, 21% year over year, the California Zephyr, 11.8% year over year, the Southwest Chief, 31.4% year over year, the Texas Eagle, 37.9% year over year, the Sunset Limited at 28.8% year over year, and lastly, the Coast Starlight at 22.6%, all contributed to boosted ridership on long distance. With that, I will hand it over to Gary Williams, our Executive Vice President and Chief Operating Officer, to share an update on our customer on-time performance.
All right, good morning or good afternoon, depending on where you are. As you can see by our customer on-time performance year to date, we're behind goal in every service but long distance, where we are on goal. We're close on state services, but have some distance to close on the Northeast Corridor. The Northeast Corridor, our challenges continue to be the legacy Acela fleet and the infrastructure reliability. A lot of work going on in both areas, and of course, our new next-gen fleet that will turn those around. On the state services side, we have some good things to talk about. Bright spots, Capital Corridor is at 91%, and Pacific Surfliner at 86%. Long distance, while we've struggled across many routes, the Crescent, with the help of our host, the NS, continues to perform well at 78%. Now, we did see a upturn in our performance in March and April. Several initiatives that came to fruition that helped the performance. April, we actually finished above goal or at goal with every service except for long distance. We were 2 below goal on the long distance side. Again, on the Northeast Corridor, our challenges continue to be the legacy Acela and the infrastructure.
Now for an update on our Customer Satisfaction Index, or CSI. At the end of April, fiscal year 25, our aggregate CSI score stood at 78.4, which trailed our year-to-date goal by roughly 0.5 points. April was the best month of the fiscal year to date, significantly closing the gap to our fiscal year goal, which stood a full point below goal as of the end of March. Key drivers to April performance included OTP, on-time performance improvements on the Northeast Regional, which drove a 3.4 point overperformance versus goal. Acela OTP was strong as well, driving a 0.9 point overachievement versus goal. OTP was strong on many of our state-supported routes as well, with the service line overperforming by 2.1 points. The Empire service had a particularly positive impact, scoring 5 points above goal with improved OTP. Lastly, our long-distance routes exceeded goal by 1.9 points, led by the Crescent, Coast Starlight, and Palmetto. Overall, we're quite pleased with the performance improvements we saw in April and continue to partner closely cross-functionally to drive gains in on-time performance and other key contributors to customer satisfaction. And with that, I'll hand it over to Jennifer Mitchell, our EVP of Strategy and Planning, to walk through an update on our host railroad responsible delays.
Thank you, Elliot. It was a mixed bag with the host railroad responsible delays. Host responsible delays during the second quarter of fiscal year 2025 decreased for state-supported services, but increased for long-distance services against our plan in the previous year. But total year-to-date delays through April remain ahead of our annual plan and the previous year. For the state-supported service, this was favorable to plan by 10 points year over year and 8 points for the second quarter. Year to date through April, it was favorable to plan and year over year by 6 points. For the services that improved, 10 out of 16 had reduced delays compared to FY24 second quarter, and 8 had reduced delays compared to FY24 year-to-date, led by the Hiawatha with 27 points year-over-year, the Vermonter with a 30-point improvement year-over-year, and Cascades with a 13-point improvement year-over-year. For the services that saw worse increased delays, that include 6 services and 8 services had increased delays, led by the Missouri River Runner with 37-point decrease compared year-over-year, the Lincoln, Missouri service, and the Downeaster. Our long-distance service line was unfavorable to plan by 4 points and at the same level year-over-year in quarter 2. Year-to-date through April, it was unfavorable to plan by 2 points and at the same level for year-over-year. For services that improved, we had 6 that had reduced delays compared to second quarter of FY24, and 5 had reduced delays compared to FY24 year-to-date. These were led by the Crescent with a 28-point improvement year-over-year, and the California Zephyr with a 10-point improvement year-over-year. For services that saw increased delays, these were led by the Texas Eagle with 28 points year-over-year, the City of New Orleans with 9 points year-over-year, and the Cardinal with a 17-point decrease year-over-year. Since the Capital and the Silver Star were replaced by the Floridian, we cannot make an exact comparison year-over-year. However, the delays for the Floridian in the second quarter of FY25 are higher than what we saw for the Capital and Silver Star delays in the second quarter of FY24. We saw increased CSX freight train interference on the Capital portion, and our Silver Star portions were the primary factors. The Sunset Limited was unchanged. And just a few noteworthy points, we did see worsened performance out of CSX. They've been struggling, but in April, the year-over-year delays were lower for the first month since September. The Floridian, which combined those 2 long-distance routes, have identified areas of improvement, but also recognized that heat orders provided an additional challenge in the spring and the summer. The auto train had elevated delays this fiscal year, in a significant part due to major track work projects that impacted all of our I-95 corridor trains. In the improved column, we saw Norfolk Southern, where delays dropped significantly beginning in August, bottoming in November, and while they've been increasing since, they are significantly reduced year-over-year. This pattern is evident on many of the Amtrak services that operated on NS, and most notably on the Crescent. And then finally, we saw improved performance on with Union Pacific. The Sunset performance has significantly improved since September 2023, with monthly 2025 improvements improved year-over-year.
All right. Closing out this portion of the presentation, we will discuss train consist fulfillment. For those unfamiliar, consist fulfillment measures how often we are operating trains with their planned consists. The highest fulfillment is on the Northeast Corridor, where recent service plan changes are helping to improve performance. Consist fulfillment is a mixed narrative for our state-supported routes. In the East, substitution of locomotives for aging and unreliable cab cars drives down the Downeaster and thus an otherwise high-performing portfolio of state-supported routes. In the Midwest, poor fulfillment is driven by regular substitution of venture equipment. Recent removal of Horizon equipment will put further strain on this region, but may improve fulfillment as there are limited opportunities for replacement equipment for ventures. On Western routes, we have multiple equipment types often operating on the same routes. With service expansion, fleets are becoming more constrained and swaps are common. Lastly, most long-distance variance is driven by fleet types with fewer than 30 units, resulting in more opportunity for day-to-day variation from planned consists. That concludes this portion of